One of the things is interesting is, and I only read about this morning, that there is some changes in the Federal Reserve Act that may allow them not to pay interest on bank reserves, which would force it into the bond market. That feels like, a backhanded way of yield curve control by forcing banks to go further out the curve. Does that?
Bitcoin has just recorded its first daily MACD Golden Cross since April, a technical setup that previously signaled a 40% rally. If precedent is any guide, the September 5th crossover could act as a roadmap toward $160,000 by October, provided market momentum stays intact. What makes this occurrence noteworthy is that the cross happened beneath the zero line, which often reflects a fading trend that is now shifting into a renewed phase of strength. This detail gives the signal added weight. Given the improving investor sentiment, the formation of higher lows, and the rise in trading volume, any pullbacks are expected to be brief. Furthermore, moderating inflation figures along with supportive consumer price index (CPI) data could act as additional tailwinds, bringing the upside target well within sight.
The thing that's been interesting to me is the shift in how the Fed and the Treasury have kind of managed the debasement. It started simply with the balance sheet. Then everyone kind of figured out that game, and then it turned into this Fed net liquidity game. And now it's gone to what we look as a total liquidity, which is including the private sector, because they're now using the banks as their main mechanism of debt monetization. Does that make sense to you?
Makes complete sense. Absolutely. I mean, I can put up some charts if you want me to demonstrate what
always
what
love a
we
good
do.
chart.
So in terms of where are we in the cycle, this is our liquidity cycle, which goes right back to the 1960s. And the sine wave there is something that we fitted back about 20 years ago in the year 2000 to show you've got this 5 to 6 year cycle, which is, I think, different to the way that you see it in terms of a 4-year cycle. But this is based on an analysis of this liquidity data. Now, how early or late are we in this cycle? Well, you can see that this is the normal cycle, the dotted black line. The low point is the trough of the cycle, and the red line is where we are now. So this looks late. I mean, we've got to accept that. We're late in the cycle. It doesn't mean it's about to end, but we've got to know we're nearer the end than we are at the beginning, and that's clearly an important factor. Now,
when do you think it finishes? By the way, my view is it's been extended. It normally would have finished sometime this end of this year, but it feels like it's going to push out into Q2 next year.
Yeah, I mean, that's almost exactly where, if I go back to looking at this cycle, that's where we would sort of suggest it's probably going to inflect sometime around about early 2026, thereabouts. Now, this chart is the one I use as a parallel to say, is there a similar cycle that you can think of? And I think back to the 80s as maybe being the benchmark, rightly or wrongly. You had the Plaza Accord, ditto the Mar-a-Lago Accord. You had rising inflation. You had bond markets, yields edging up. You had commodity prices beginning to boom. And then you had the crash, which was pretty much triggered. I'm old enough to remember it, but it was triggered by the Germans saying they were thinking about raising interest rates, which spooked Treasury Secretary Baker at the time, because the US were really angling for lower rates now. And then, the proverbial, SH1T hit the fan, and market investors realized that the liquidity cycle was about to reverse. And that's what happened. Now, we could easily be, as this diagram says, a good 6 months away from that. So, watch this space, but we've got to be alert to those factors. Now, to come to your point about, and I can always come back to these charts, what's happening in terms of the Treasury. This is what we reckon is going on in terms of the sources of monetary stimulus in the system. And what this diagram breaks down is 3 different categories. One is conventional plain vanilla QE, which is, using the SOMA account at the Fed, in other words, expanding the balance sheet to stimulate, which they clearly did a lot of in COVID, and that's the red area. You've also got, if you like, the backdoor stimulus, which is what we loosely or flippantly call not QE, which is the hidden QE, which is things like the Treasury General Account.
The present market setup seems stable and encouraging. The MACD line is positioned above the signal line, while the RSI continues to strengthen, and price levels are being recovered in a way that suggests room for sustained momentum. Buyers are re-entering the market, and the $160,000 target remains technically justified so long as recent highs hold steady. Broader macroeconomic forces also add support, with declining inflation pressures providing a favorable backdrop. Both gold and cryptocurrencies benefit from this environment, yet the combined technical signals strongly suggest that the phase of downward movement has concluded and that a fresh cycle of accumulation is underway.
The bank term funding program, the losses they're making on interest payments to the banks, and the reverse repo program rundown. That's the orange bit. Now you see those things are kind of exhausted. I mean, they can revive if they decide to change from QT again to QE, but at the moment they're spent. And then what you've got is the black area, which is what we call Treasury QE. And that really comes by shifting the duration of issuance from longer dated debt to shorter dated instruments. And the reason that's important is that, very crudely, we tend to think that liquidity is equal to an asset divided by its duration. So if you're reducing the average duration or maturity of assets out there in the private sector, you must by definition be improving liquidity. And the black area is the impact of this big issuance or wave of issuance of bills and short dated debt, through the Treasury calendar, as opposed to coupons. So you can see it's becoming material. There's a little bit of a lull right now in terms of that stimulus, which may explain why the economy is soft, but it does pick up, and that's why this is a critical point. Now, as I stressed a second ago, the fact is that banks in particular love this stuff, and so as it happens do stable coin issuers. They like short dated debt and they like bills. But if any credit provider buys government debt in whichever shape or form, but they particularly like short-dated stuff, it's monetization. And this chart here is looking at the growth of Treasury and agency securities among commercial banks in the US relative to disconventional weekly money supply growth. And you can see that there's been this big acceleration in the growth of treasuries, government debt, which is telling you they're monetizing the deficit. That's the main source of monetary growth right now.
Now, as we know, the liquidity game is a global game. It's not just the US. You wrote this morning about China. I've been looking at China. It feels that China's picking up its stimulus program as well.
Yeah, I'll show you I'll come back to there's a point about Japan, which I can come back to.
Yeah, well, we can go to Japan straight and then we can go to China if you're next on Japan, because that was interesting as well.
I think this is a point to ponder. I'm not going to say I'm right on this, but I think it's a point for people to ponder. Is that what you've got in Japan is clearly rising yields. And this chart is illustrating the 10-year yield. And that's the orange line. And the dotted line is our estimate of fair value without all the various encumbrances of what was then in Japan called QQE or yield curve control, or these factors. So that's where effectively the Japanese long bond or the 10-year bond is heading to. And that rising pressure on yields is clearly something that's spooking investors right now, because they say, here we are, 1987 crash redo. We're going to get another episode of rising bond yields, which scupper the equity rally. Well, that's possible, of course. But then if you disaggregate term premia, which are, although a wonkish concept, are invaluable when you're understanding bonds, because it shows the risk premium on a sovereign government debt. What this chart here is doing is disaggregating term premia in Japan into three different channels. The red line, which is the one that's really been moving, is the ultra long-term bonds, so nearer the 30-year tenor. So that's been shooting up, right? Dramatically since that graph started. And then the other two lines are looking at medium and short-term JGB risk premia or term premia. Now, the reason that I'm making this distinction is that if you looked at a comparative economy like Britain or France, to name names, you'd see all three segments of term premium moving up together in sort of harmony or disharmony, whatever way you'd like to put it, because effectively investors right across the curve of all stripes are dumping government debt because they don't want the sovereign risk. In Japan, something really different's going on. It's only the ultra long-term debt that's really being seriously dumped. And isn't that a switch from bonds into equities? Because that type of debt is really a substitute for equities. And so people are just saying, look, hey, we've got inflation now in Japan. We're going to be destroyed. Wealth's going to be destroyed in the bond markets, the long-term bond markets. So let's switch into equities. And that, as we know, has coincided with a big rally in the Japanese stock market.
Why are the Japanese tolerating it? Because that's the one thing is, look, the Japanese are very smart in how they manage their monetary policy. They understand this